Hi folks, welcome to our next recording on the foreign currency translation topic, and specifically temporal method. Last time we left off, we had translated the income statement for the foreign subsidiary and included in net income the foreign currency exchange gain or loss, and in this case it was a $2,000 loss translated. Now we're going to do the balance sheet. But before we do, just remember that when you are using the temporal method, the foreign currency exchange gain or loss goes into net income. It's different under the current rate method, right? But we'll get to that when we study that, or when we review that in the video. Now, if we look at the balance sheet here, we know that all of our monetary items have to be translated at the spot rate, and we have that for cash and accounts receivable. Don't forget, inventory is non-monetary, so we need the historical rate, which is given to us in the question as 0.027. So we're going to translate the ending inventory to be 130,000 Canadian dollars. Don't forget things like prepaid expenses, unearned revenues, which we'll get to shortly in the liability section. They are all non-monetary, so they're translated at the rate, the historical rate you're given in the question. And for prepaids at the end of year 4, it's going to be 0.03 per the question, so we translate that to be 57,000 Canadian. Plant assets, you remember we said earlier when we were calculating depreciation expense, we said that we are going to use the historical rate. And don't forget, we had two historical rates for the plant assets because they were both purchased at two different times. The first plant asset, which had a book value of 2.8 million Indian rupees, was purchased in the beginning of year 2 when the spot or the historical rate was 0.075, and the asset that was purchased in or developed in June year 3 had a historical rate of 0.062, so we apply that to the net book value we calculated earlier, and we get 316,000 for a total of 526,000. So our total assets are adding up to 888,000 Canadian. Don't worry about the current rate method. We'll get to that in a moment. Let's just focus now on the rest of the balance sheet under temporal. Again, we have our current liabilities at the spot rate because they are monetary. And again, our unearned revenues are non-monetary, so we use the historical rate we're given, 0.028. That's given to you in the question. So that translates to 22,000 Canadian. And again, your long-term debt is at the spot rate because it is monetary, and it's 150,000. Common shares are translated at the historical rate all the time under both current rate method and temporal method, so we get 750,000. Now, the question didn't give you enough information to calculate the actual amount of retained earnings at the end of year 4, so we just plugged it to balance, and we get 888,000. Now, that's the temporal method. Let's go back now and look at the current rate method. The current rate method is a little simpler because all assets and liabilities, regardless of whether they're monetary or not, are all translated at the current or spot rate. All of the income statement items, much like the temporal method, are translated at the historical rate. However, if it's not known, you use the average rate. In our question, a lot of those actual historical rates aren't known, so what are we going to do? We're just going to apply the average rates to everything. So in our case, we are going to apply the average rate to our cost of goods sold, because again, the fact that it's made up of monetary as well as non-monetary, and here's your two non-monetary items for inventory, it doesn't matter. All assets and liabilities are going to be translated at the same rate. So we don't even need to take that kind of thing into account. What we do need to think about is that the cost of goods sold is an income statement account, so we're going to use the average rate, which is 350,000. Similarly with depreciation, because depreciation is an expense, we're going to translate all expenses at the average rate. It doesn't matter that they were bought at two different points in time, because the assets and liabilities or the non-monetary items are all translated at a current rate. So it doesn't matter. We're going to calculate depreciation and translate it at the average rate, which is 31, which gives us 31,000. Similarly for interest as well as taxes over here, we're going to get the same answers we did under the temporal method. So our net income in this case before a foreign exchange gain and loss is 99,000. Now notice I don't have anything in here for foreign exchange gain or loss in the income statement, because all calculated foreign exchange gains or losses losses under the current rate method go into other comprehensive income, which is not part of your net income calculation. So your net income is going to be $99,000. Now, if the question asked you to calculate comprehensive income, it doesn't, but if it did, what we could do is we could go down and do a little calculation as I've done here. So if you wanted to find the foreign currency exchange gain or loss under the current rate method, all you would do is translate similar to what you did before when you were trying to calculate the foreign exchange gain or loss under the temporal method, do a little chart. The only thing that's going to be different here is that instead of looking as we did under the temporal method for the items that are giving rise to our foreign currency exchange gains and losses as a result in changes of our monetary position, and we did it at that time because monetary items are translated at the current or spot rate. Now, because we've got all assets and liabilities translated at the current or spot rate, we're going to look at the change in your net asset position. Net assets, as you remember from your intro financial, are assets less liabilities, and that's equal to shareholders' equity. So therefore, what we're going to do is we're going to look at anything that gave rise to the change in shareholders' equity. Now, because there were no new shares issued, that depends on what our income was and what our dividends were. So our equity position was changed as a result of net income earned and dividends. So now we know from our question that net income was 3.2 million rupees, translated at 0.031, gives us 99,000 Canadian. Again, our dividends are translated, or 3.5 million rupees, translated at the spot rate, which is 0.025, is going to give us 88,000, okay, as something that decreased our net asset position because dividends declared decreases equity, right? And don't forget, we started off with our net asset position at the beginning of year 4. You can take a look at what's in the equity section of the foreign subsidiary at the beginning of year 4, and that's 12,400 when you add the common shares and retained earnings, translated at the then spot rate, which was 0.041, to give you rounded 521,000 Canadian. So if we add to this opening net asset position our income and deduct dividends, we're going to get a calculated position of 532,000. Now, if we compare that to the actual position, and with the actual position, we would then go and have a look at what our net asset position is when we have a look at the balance sheet at the end of year 4 for the foreign sub. And we'll see if we look at that, we get common shares and retained earnings of 12.4 million in rupees. Right? And then we're going to translate that at the spot rate because all assets and liabilities under the current rate method are translated at the spot rate. We're going to get 310,000. So now because we had the sub do it for us, we have a net asset position of 310,000. However, if we had done it ourselves, we would have had a net asset position which was bigger at 532,000. So in this case, because we had the sub do it for us, we have a foreign currency exchange loss of 222,000, and that is going to OCI. So now what we would do here is, if the question said to calculate comprehensive income, what I'm going to do now is just kind of redo this little guy for you and show you what it might look like. I don't want any underline there, so just go into Word and change that. Then I would get here a net loss, as we saw, 222, and that then would give me comprehensive income. And again, question didn't call for this, but if it did, it would give you comprehensive income of negative 123,000. Right? So you have to watch the question carefully to see what it's asking you to do. This question was just asking you to calculate income, so you didn't need to do this piece. But again, if they had asked you to calculate comprehensive income, if you were using the temporal method, comprehensive income and net income are the same. But comprehensive income under the current rate method would be negative 123,000. Okay, so you just have to bear that in mind. When we're doing the balance sheet now, under the current rate method, very simple. We don't need to be worried about different historical rates because all assets and liabilities are going to be translated at the spot rate. So I'm just going to take for cash and receivables what I had under the temporal method because they're at the spot rate, but all my ending inventory, my prepaid expenses, and all my ending balances for plant assets all now at the current rate. So I'm going to get total assets of $541,000. If I go down to the balance sheet, similar thing. Current liabilities will all be translated again as it was in the temporal at the current rate. Same under current rate method. The unearned revenues as well would be translated not at the historical rate, but again at the same spot rate as I've been translating other items so far under the current rate method. Our long-term debt, again, under the temporal, we use the current or spot rate. We use the same thing under the current rate method, and we're going to get $230,000 for our liabilities thus far. Now, the common shares, again, both at the historical rate, whether it's temporal or current rate method. But now you'll see they did a funny thing here. They actually just plugged this to balance, $439,000 as the retained earnings deficit. Technically, that's not a retained earnings deficit. It would be made up of, under the current rate method, retained earnings as well as reserves or AOCI. So you would need to know more about what the opening balance may have been in AOCI. We don't really have any details here of what that may or may not have been. We don't really know. The question doesn't tell us a lot, but you would really need to split that up. If you made the assumption that the AOCI balance was 0 at the beginning, then what you could do here is you could split that up, and you could say, well, if you were doing the balance sheet now, I might have that set up a little bit differently. I might say then that my AOCI, so if I had decided, or if I had retained earnings, let me just see here what what the best way is to do this. If I had AOCI, or as we now know it, reserves, I guess I got caps on, hang on a second. AOCI, we could assume that if we had no opening balance of AOCI, that we would have negative 222, right? Because that would have been our exchange gain or loss that we calculated, remember, down here, and that would go to OCI. If we had no opening balance for AOCI in the balance sheet, or as we call it now under IFRS reserves, we would show this. But then to balance, what would this be? Then this would be 217, because I need to get this to come to 439 in order to balance to 541. So, and then I'll just get rid of that. So it would be a little bit different, but I guess in the solution they just didn't, I don't know, they just didn't set it up that way. It is kind of odd. They just kind of plugged everything. But if you assume that the opening balance for AOCI was 0 at the beginning of year 4, and now you had OCI for this year under the current rate method of 222, you just add it in there, and then your solution would look a little bit like this. So anyway, this concludes our discussion on this review question for foreign currency translation under the current rate method. So hopefully you found this video helpful, and good luck on the exam.